We all dream of growing our wealth, don't we? But then there's this thing called compound interest. And look, we all know it's powerful, but the math, it can feel a bit much, right? It kind of leaves you with one big, simple question.
Like, seriously, how long is it really gonna take? 5 years, 10, maybe 20? Knowing this, even just a rough idea, helps you plan, set your goals, and make way smarter choices. Especially when you're trying to decide between different investments like stocks or maybe safer bonds.
Okay, so calculating the exact time it takes for an investment to double, it actually involves some pretty complicated math. We're talking natural logarithms here. You'd need a scientific calculator, and let's be real, who carries one of those around when you're just trying to size up an investment opportunity?
But what if there was a simple trick? A way to just cut through all that complicated math? What if you could get a surprisingly accurate guess in just a few seconds using math you can literally do in your head? Well, there is, and we're going to get right into it.
It's called the Rule of 72. And listen, this isn't some newfangled financial trend. It's a time-tested shortcut that goes all the way back to 1494. It was first mentioned by an Italian mathematician named Luca Pacioli. For any investor, this is a seriously powerful tool to have in your back pocket.
So what is it exactly? Well, the Rule of 72 is basically a quick mental calculation. It helps you estimate how many years it'll take for an investment to double in value, assuming you get a pretty steady annual return. Think of it as the ultimate back-of-the-napkin financial tool.
And here's the best part. It is so simple to use. All you do is take the number 72 and you divide it by whatever your expected annual rate of return is. That's it. Seriously. The number you get is a really good estimate of how many years it's going to take for your money to double. Easy, right? All right, theory's great, but let's put this rule to work in the real world. This is where it really shines, helping you quickly size up different investment options against each other. And this is where you really see the power of this simple trick. Okay, so let's imagine you invest in an S&P 500 index fund. That's just a basket of the 500 biggest U.S. companies, and historically, it's averaged around a 10% annual return. You do the math, 72 divided by 10, your money doubles in about 7.2 years. Not bad. Now let's compare that to, say, a high-yield savings account that's getting you 3.5%. All of a sudden, you're looking at over 20 years to double your money. The difference is just huge. Yeah, this chart just makes it crystal clear, doesn't it? You can literally see the trade-off, the potential for much faster growth with stocks versus the safety you get with a savings account. I mean, we are talking about a 13-year difference in the time it takes to double your money. That is a massive gap when you're planning your financial future. So the big takeaway here is that this isn't just some neat math trick. It's a really practical tool for making quick risk versus reward decisions. If you're a stock investor, this is golden. You can instantly figure out if a high-growth tech stock that's aiming for 15% returns fits into your 5-year plan, or if maybe a stable dividend stock offering 4% makes more sense for a 20-year retirement goal. But the Rule of 72 isn't just about good news and growth. It's got a flip side, a darker side, you could say. And it's just as important to understand because it shows how quickly things can start working against you. Let's talk about inflation. If the inflation rate is, say, 4%, you can use the rule to see how fast your money is losing its buying power. So 72 divided by 4, that's 18. What does that mean? It means in just 18 years, that cash you have stashed away will only buy you half of what it can today. This is exactly why investing to beat inflation is so critical. And it also works for debt, and this is where it gets genuinely scary. Think about a credit card with a 12% interest rate. The Rule of 72 tells you that the amount you owe will double in only 6 years. Wow. That is a powerful and, frankly, a pretty sobering reminder of how quickly high-interest debt can just spiral out of control. Okay, now, as fantastic as this little shortcut is, it is not a magic wand. And to use it well, you have to know its limits. This is the fine print that every single smart investor needs to be aware of. All right, first things first, it's an estimate, an approximation. It's a great mental shortcut, but it's not a precision tool. It also assumes a constant rate of return, which, well, if you've ever watched the stock market, you know that almost never happens. Real returns go up and down. And of course, it doesn't factor in things like fees, taxes, or if you take money out, all of which will absolutely affect your real-world growth. I absolutely love this analogy. It just nails it. The rule is like trying to measure a gemstone with your hand. It gives you a feel for the size, a quick impression of its value. But if you wanted a precise appraisal, you need some serious, sophisticated tools. It gets you in the ballpark, not the exact seat number. And it's also worth knowing that there are a few other versions of this rule floating around. You've got the rule of 69.3, which is more mathematically exact for something called continuous compounding. The rule of 70 is often used when people are talking about inflation. But for just everyday mental math, the rule of 72 is king. Why? Because 72 is so easily divisible by a bunch of common numbers, which just makes it the handiest one of the bunch.
So where does that leave us? After all this, what's the real takeaway here? How should you think about the rule of 72 as you're planning your own financial life?
Look, the rule of 72 is not a crystal ball, but it is an incredibly powerful back-of-the-envelope tool. It empowers you. It takes this big abstract idea of compound growth and makes it simple. It lets you quickly compare investment options and get a real gut feeling for how your money or your debt is going to grow over time. It basically brings the awesome power of compounding into sharp focus with just a little bit of simple division. It's a tool that helps you ask better questions and ultimately make more informed decisions. So the only question left for you is, now that you've got this shortcut, how are you going to use it to plan your future?